is Manishi Raychaudhuri, who is the veteran investor in Asian equity. Manishi, hi. How do you look at this trade, given the fact that we are seeing a tech and semi rout happening in Asia?
Absolutely. Thank you very much for having me. It's very good morning to you and your viewers here. So it's red all over Asia, right? And in particular, in the North Asian markets, the Korean and Taiwanese markets, which had led this skyrocketing rally that we had seen in Asia. Why did this happen? Because there were quite a few things combining over Friday and the weekend. Number one, we had this guidance from Broadcom about their chip revenue. About, I think they talked about 200% growth, close to $16 billion, which might sound impressive, but at the same time, given the inflated expectations that the market has, it fell slightly short of those expectations. Number two, we had a pretty good jobs report, non-farm payroll report from the United States, which ignited expectations of a rate hike possibly in the next meeting, as early as the next meeting. Third, the U.S.-Iran, this so-called treaty and ceasefire, that seems to be a case of 2 steps forward and 2 steps back. And now we're hearing news about renewed military tensions between Israel and Iran, leading to another spike in oil prices, which is, and when you put all this together, it is, it's not only a kind of a disappointment to the market, it kind of ignites the possibility of increase in cost of capital, and therefore it induces investors to sell down and book profits in exactly those companies, in those stocks where they have made money. So it's no surprise that the Korean and Taiwanese tech giants are being sold down. But at the same time, we must also remember that this is just a reduction in the valuations, and some of these valuations are already cheap over there. The earnings estimates and this superlative growth in earnings estimates that we have seen, that's still very much intact. Memory prices, semiconductor prices are not really likely to be driven down anytime soon. AI capex demand remains intact. So I would rather treat this correction, this significant correction over Friday and today in North Asia as a buying opportunity.
Do you see any, funds, churning out from the Asian markets for the mega IPOs which are coming in, especially SpaceX, which is coming in this week?
Right. Now, that seems to be the conversation. I was on another electronic media this morning, and that question seems to be coming up. I think to some extent that may be happening because the SpaceX, the sheer IPO size, $75 billion, is huge. But, I would not be too concerned about that because, and I personally think that this sell-off that we're seeing is more to do with the short-term concerns that we're seeing over the last 3 days than any, sort of immediate urge to invest in a new IPO. There are quite a few of these big IPOs which are coming up, and they would almost certainly suck out some of the liquidity from the secondary market. So we have to brace for this kind of volatility. But I would not be too concerned about those phenomena.
Manishi, if I can quickly come to you as well. Hi, this is Harsh joining the conversation. Give us a sense, how are you looking at Indian equities relative to Asia now in terms of valuations? You stand at a very interesting confluence, right? Manishi, you understand India, you understand Asia. How are valuations looking, and what will it take for FIs to really start coming back? Because that could be the turner.
Right. Great. Thank you very much, Harsh, for that question. So if you look at the absolute valuations of India, Nifty, Sensex, or MSCI India, they're possibly somewhere around 19 to 20, maybe a bit lower today after this correction today, somewhere between 19 to 20 times 1 year forward PE. Now, Asia ex Japan or emerging markets, these are about 30% cheaper. So they're possibly around 14 times, 13.5 to 14 times. If I go back to the Indian peak, which was September 2024, that premium that India enjoyed at that time was 87%. It was humongous. India was unequivocally too expensive at that time. Today's premium is in line with the long-term averages. If you look at last 15 years, average premium that India has enjoyed, it is down to those levels. But the question here is that are those historical premiums really applicable going forward? Should India trade at a premium to Asia and at a significant premium to Asia going forward? I'm asking this question because the kind of earnings growth premium that India used to enjoy earlier, that may not exist going forward. We're living in a much more complicated world. We're living in a world where geopolitics and trade, for example, is way more difficult than it used to be. We're living in a world where consumption sentiment in particular is likely to be depressed by the very tepid and uninspiring employment situation in India, which wasn't the case earlier. Right. So, just because the Indian premium has come down to the long-term average levels, it may not trigger FII flow right now. What needs to happen for foreign institutional flow to be triggered again is that the growth estimates need to go up for India again. Today, India is in a situation where the earnings growth, corporate earnings growth for this year, fiscal 27, is likely to be in single digits, like we saw in last year in fiscal 26. That's not quite inspiring. That's actually quite pedestrian compared to what's happening in, say, China, Taiwan, and Korea. On top of that, Indian earnings estimates are also coming down. I mean, I talked about single-digit earnings growth now, about 9 to 9.3%. If you go back about 9 months, that same estimate was 16% for fiscal 27. Analysts have been whittling down their estimates continuously. And that's exactly the opposite of that is happening in North Asia. So these two things clearly need to be sorted out. I mean, number one, earnings estimates need to go up. Earnings growth has to go back in double digits. Market has to gain some confidence that these earnings estimates are likely to be sustainable and not be whittled down going forward.
Manishi, when investors look at earnings, they look for the benchmark earnings growth, which is there, and our benchmark earnings, benchmark indices, are based on market cap based and not earnings growth based. You saw the S&P, rejecting the proposal of adding mega caps to its indices, and they want the 12-month seasonality and profitability as one of the targets for any company to come into the index. Do you think we should also look at that so that you get a optimal earnings growth kind of index?
Ideally, for any stock to be added to a benchmark index, it should have a trading history and a few years of earnings history. I mean, I don't agree with some of the really newly listed stocks being included into the frontline benchmark indices immediately upon listing, or maybe 3 to 6 months after listing. There should be a longer term time horizon, because it does give an opportunity for investors to look at what the correct valuation multiple for this stock is likely to be in a steady state. It also gives, right on listing, the only banks which are covering that stock are just those banks which were involved in the underwriting process. But the analyst base that needs to get widened to get a slightly more legitimate earning estimate for that stock. So yes, I tend to agree with what MCI has talked about recently. So yeah, I mean, and right now we're seeing an extreme degree of concentration in many of these frontline indices. Just one stock in Taiwan is about 50% of MSCI Taiwan. Just two stocks in Korea are about 45% of that market. So it is becoming difficult for active managers to trade these markets and beat the indices. But I think there's a degree of percolation that's also happening. We are seeing employees in the AI and chip sectors having their earnings, their wages, their bonuses moving up consistently, and therefore that having an impact on consumption sentiment. We are seeing that happening in the earnings estimates of the banks and financials in these locations. So, I'm hopeful that this extreme degree of concentration would possibly sort itself out.
And Manishi, last couple of years, private sector banks have really not done well. That was
Yeah.
one of your top picks, if I can call it that. Would you
Yep.
attribute that underperformance only to flows? Would you say that because of flows turning adverse, it's not played out? Or do you believe that fundamentals too have shifted? And give us a sense of how you look at them today.
All right. So the first point is that, yes, in the Indian context, within India, the private sector banks still remain one of my favorites for two simple reasons. Even if we have nominal growth of, let's say, 10% or so, um, it has to be, after all, think of consumption, investments, net exports. It has to be driven by consumption and investments. And there, pretty much the banking sector will have to finance it. Within the banking sector, the private sector banks are still, they don't have a dominant market share. They hardly have about 30 to 35% market share. And because of their superior technological prowess, they're gaining market share over the public sector banks. So broader economic growth and the private sector banks gaining market share consistently, these are the two main drivers for the private sector banks over the long term. I'm also positive, constructive about the fact that the leading private sector banks are not as expensive as they used to be. I mean, think of HDFC Bank, which used to have a price to book multiple of 4 times at one point of time. Today, it's at around 2 times. So, I think I'd still remain positive, but I think, India itself is not really garnering significant foreign investor interest right now. As long as they continue to sell, the selling pressure will have to come in those stocks, which are, I mean, today the banking sector is about 30% of the market, right? So those frontline leading stock have to bear the brunt of this FII selling. If one has a longer term time horizon, 3 to 5 years, I would still remain positive on that space.
Manishi, how do you look at the broader market, mid cap and small cap? Because there we have pockets of growth which is much better than the
Yes.
flagship companies.
Interesting. Yes, you're right. I mean, in the mid cap and small cap universe, we have a much better growth environment and possibly even growth adjusted valuation environment. We actually did this exercise recently. We looked at all stocks across Asia which have a market cap of $1 billion or more, and within them, which are the stocks that have a strong growth forecast, maybe 10 to 12% earnings growth over the next 2 years, compounded annually, or higher than that, which also have a reasonable valuation, maybe a P to earnings growth of 1.2 times or less, and decent balance sheets. The debt to equity ratio of less than 100%, less than 1 time. It is very difficult to find large cap stocks in India which fit that description. Large cap being more than $10 billion of market cap or more. We could just find two. And there are a whole host of them in North Asia. But when it comes to the small and mid caps, there are quite a few more. I mean, there are a few in engineering, there are a few in the consumer and consumer proxy space. There are quite a few, among the diagnostic space, hospital chains, etc. So if you look at the private sector lenders, if you look at the industrials, if you look at the capital goods and consumer discretionaries, you do have a significant quantum of these small and mid caps, which actually fit those description of decent growth combined with reasonable valuation multiples and and good balance sheets. So I think that space in India is now beginning to look interesting.
And Manishi, give us a sense of private versus PSU banks. This entire theme of PSU banks taking up market share, does it concern you? Does therefore the multiple shift, because PSU banks traditionally used to trade at maybe half time book. Yeah. Now they trade at 1 time book. So there's been a significant re-rating there. And probably that's one of the reasons why private sector banks have lost their premium valuation. Can they go back to some extent to the premium valuation? Maybe not entirely to 4 times book, for example, for HDFC, but maybe 2.5, 3 times. Is that scope there?
I think, to answer your second question first, I think the banking universe, both the private and public sector, would be driven more by earnings growth than by valuation re-rating. There could be some, valuation re-rating in both spaces, the PSU and the private sector banks, but it has to be driven more by earnings than by valuation re-rating. And your point about the PSU banks getting re-rated, yes. I mean, they used to trade at ridiculously cheap valuation multiples, and now they have come up to about 1 times. I would be a bit more selective among the PSU banks universe, because structurally, I believe that in India, the private sector banks would gain market share in the long term. If you look at the next maybe 10, 15, 20 years, it's the simple, the technological prowess of the private sector banks, which has stood them in good stead, and it is going to support them in terms of their gaining market share, both in terms of lending and also access to the relatively cheap, cheap deposits. So I would structurally be more positive on the private sector banking universe. A couple of leading public sector banks may still participate in that rally over the long term, but my bigger, kind of emphasis would still be on the private sector.
All right, Manishi, thank you so much for joining us, giving us that perspective with regard to markets as a whole. It's an interesting conversation.
Thank you.
All right.